Hello. In this video, we'll be going over current liabilities, what they are, and specifically accounts payable and trade notes payable. So before we get to what is a current liabilities, we have to know what is an actual liability, just in general. A liability is on the balance sheet, and if you remember, the balance sheet is assets equals liabilities plus stockholders' equity. And so this entire chapter is devoted to liabilities. And a liability is a present obligation to transfer an economic benefit. The economic benefit can be derived from a contract or from past behavior. So, and it's basically we owe money or some sort of an asset to satisfy an obligation that we have incurred, whether that's from past behavior such as we owe our employees money for the hours that they have worked, or from a contract, most notably, like if we have a loan from a bank and we have a contract that we owe them XYZ on certain dates. So basically, a liability is debt that is owed. There are two different classifications for liabilities that you will see on a balance sheet. The first one that is listed will be the current liabilities, and then you'll have non-current liabilities, or sometimes called long-term liabilities. We're going to focus on current liabilities, which again is a future obligation that is owed. And this obligation is owed within 1 year from the balance sheet date or within the firm's operating cycle, whichever is longer. Typically, most companies' operating cycle is shorter than a year. So current liabilities are typically, not always, but for purposes of this video and future videos for current liabilities, we're going to assume that it's just current liabilities are due within 1 year of the balance sheet date. A current liability can be satisfied, which means it can be paid with current assets, typically cash, or it can be paid off or created with a different current liabilities being issued. Also, it can also be satisfied with, you can pay off a current liability with either accounts receivable or inventory, some other assets. Usually it's cash. All liabilities should be recorded at their present value, which means that you record it at the present value of the principal plus any interest that may be owed. However, for current liabilities that are payable within 1 year, we typically only record it at the maturity amounts, or think of it as their face value. Most common examples of current liabilities that you will see on a balance sheet are accounts payable, notes payable, commercial paper, income tax liability, dividends payable, and accrued expenses. Income tax liability is its own, income taxes are its own chapter, and we will cover income tax liability in the future. Let's just quickly look at a balance sheet from General Mills in their liabilities and equity section, and see here, this is the classification for the current liabilities, and they list the accounts payable, current portion of long-term debt, which we'll get to in a different video, any notes payable, so these notes payable are due within 1 year or less, and any sort of other current liabilities that they have. Let's discuss specifically these two different types of current liabilities, accounts payable and trade notes payable. They are similar yet different. Accounts payable is typically the first current liability you will see on a balance sheet. As you can see here on the General Mills, accounts payable is the first one. And these are obligations or amounts that we owe to suppliers of merchandise or services. So typically for companies that purchase inventory, they they put a purchase order for inventory. They receive an invoice for that inventory. And when they receive the invoice, that's when they record the accounts payable. And the accounts payable is like kind of like, think of it as an open credit with that specific supplier, that you have an agreement with that supplier that once they give you an invoice, there's terms on that invoice, but typically that invoice will be due within 30, 45, or 60 days. So once we receive the invoice, we will record the accounts payable. And it's typically, like I said, within 30, 45, or 60 days, but that's why it's a current liability. And these do not accrue interest. So because it's payable, it's like you have an open account with your supplier, and it's typically for suppliers that you have a lot of business going back and forth with. Trade notes payable are different because they still are current liabilities for to our suppliers of merchandise or service. However, they are backed with a actual promissory note, like a written note or contract, if you will, and they're typically longer in duration. Now, when we're talking about current liabilities, these will be due within a year, but these trade notes payable might be, let's just call it 6-month or 9-month duration. So it's taking the company longer. If a company expects that it will take them longer to pay their suppliers, the suppliers might demand that they issue a trade notes payable. And the biggest difference between accounts payable and trade notes payable, besides the written promissory note, is a trade notes payable bears interest, which means that the company that has the notes payable on their books will have to pay interest to their suppliers.